Let's explore this exercise that relates to discontinued operations and earnings per share. All right, I'm going to read the information that's provided. Chance Company had two operating divisions, one manufacturing farm equipment and the other office supplies. Both divisions are considered separate components as defined by generally accepted accounting principles. The farm equipment component has been unprofitable, and on September 1st, 2024, the company adopted a plan to sell the assets of the division. They gave us 4 bullet points. All right, just read right to the right of my mouse here. The actual sale was completed on December 15th, 2024, price of $620,000. The book value of the division's assets was $1,050,000, resulting in a before-tax loss of $430,000 on the sale. The division incurred a before-tax operating loss from operations of $150,000 from the beginning of the year through December 15th. That's when the sale was complete. Okay, their after-tax income from continuing operations is $570,000. The income tax rate is 25%. Now, what I have below here is what the partial income statement would look like, and I have a couple items hidden for now. All right, first thing I want to point out, when we have discontinued operations, we usually have 2 lines. We have a section that talks about the loss or gain from operations of discontinued components, and then we have a line for the income tax benefit. We have to show the proper tax treatment of the discontinued operations. All right, now, going back to the top, we see that their after-tax income from continuing operations was $570,000. So that goes right here, $570,000. All right, next, look what they say here. The book value of the division's assets was $1,050,000, but I want to focus on the $430,000. It had a before-tax loss of $430,000 on the sale. So this is the item, the division we're selling. And they also had a before-tax operating loss of $150,000. Okay, so if we add that together, the $150,000 loss, the $430,000 loss on the sale, plus the $150,000 they lost on operations, if we combine those, we get $580,000. That's the loss from the operations of the discontinued component. Now, $580,000 times 25% income tax rate, that's what we're going to apply to it. That becomes $145,000. Okay, so from there, we've got the 580 less 145. Got an extra line here. I don't think we need it. Now we can figure out what our income loss on discontinued operations becomes. It's 435, right? 580 less 145 is 435. Income from continuing operations plus the 435 loss, positive number and a negative number, gets us net income of $135,000. Okay, so next we get to the earnings per share portion, and here's what it says. Include appropriate earnings per share disclosures, assuming that 100,000 shares of common stock were outstanding throughout the year. So we need to show what the income was from continuing operations on an earnings per share basis, as well as what was the loss or the earnings per share from based on discontinued operations. All right, so if we take 570,000 and we divide it by 100,000, what we get is $5.70. Okay, and then if we look at our discontinued loss, which was 435, that's a loss. Divide that by 100,000, we get $4.35. All right, so then we just have to do the math to come up with what the difference is, and it turns out to be $1.35 per share.